Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of big companies and pull out the juicy bits for you to understand faster than you can say Securities and Exchange Commission. Today we are looking at Bausch Health Companies Incorporated, and let's just say they're playing a bit of financial rearrange. So what is Bausch Health Companies Incorporated all about? They are a global company focused on healthcare products. Think things like pharmaceuticals and medical devices that help people see better or live healthier lives. They've been around for a while and have seen their share of ups and downs. Now, the main event in this report from the 8th of December 2025 is about something called an exchange offer. Imagine you have an old IOU from a friend that needs to be paid back next year. You hear they might be able to get a new IOU that you'd get paid back later, but with a higher interest rate. That is kind of what is happening here. Bausch Health is offering to swap out some of their older debts for newer debts. Specifically, they are exchanging their 4.875% senior secured notes due 2028 and their 11.00% senior secured notes due 2028 for new 10.00% senior secured notes due 2032. So they are basically trying to push their debt payments further into the future by issuing new bonds. They are offering up to $1.6 billion worth of these new bonds. The reason they are doing this is likely to manage their cash flow and maybe get better terms on their debt. This is all part of how companies manage their money and debts. You see this kind of thing quite a bit when companies want to restructure their finances. They are essentially saying to the people who lent them money here, have this new promise to pay you back. But it is going to be later and will pay you a bit more interest for it. Now, while this report doesn't give us a full deep dive into their financial statements like a big quarterly earnings report, it gives us a snapshot of a specific financial maneuver. It is not about how much they earned or lost in the last quarter, but rather how they are adjusting their financial structure. This is a strategic move designed to give them more breathing room. By extending the maturity dates on their debt, they can avoid pressure to repay large sums of money in the short term. This freed up cash can then be used for operations, research and development, or other investments that can help the company grow. However, taking on debt with a higher interest rate like the 10.00% means they will be paying more in interest over the life of the new debt. So it is a balancing act. They gain flexibility, but at a higher cost. This filing is essentially an announcement of early results for these offers. It tells us that the company is moving forward with this debt restructuring. It also includes a press release which would give more details about the success of the offer, how many people decided to exchange their old notes for the new ones. We can't see the exact numbers here, but the fact that they are talking about early results means that the offer is open and people are responding. The securities that Bausch Health has out there are their common shares which are traded on major stock exchanges like the New York Stock Exchange and the Toronto Stock Exchange. When a company does something like this exchange offer, it can sometimes impact the perception of the company. Investors will be looking at this to see if it is a sign of financial strength and good management or a sign of distress. In this case, it appears to be a proactive financial management move. Looking at this from 30,000 feet, it is a smart move for a company to adjust its debt profile. It shows they are looking ahead and trying to smooth out their financial obligations. The key will be how well they can manage the increased interest payments and how effectively they can use the freed up cash flow to drive future growth. If they can do that, then this exchange offer is a positive step. If they struggle to generate earnings, then the higher interest payments could become a burden. So what is my take on this? Bausch Health is making a calculated financial play to manage its debt load. They are essentially refinancing their debt to give themselves more time and flexibility. This is a common strategy in corporate finance. The strength of this move will depend on their ability to generate sufficient revenue and profit to cover the higher interest payments on the new notes. The company's direction seems to be focused on financial stability and ensuring they have the resources to operate and potentially grow. The main risk is that if their business performance falters, the higher interest expense could put them under more pressure. The opportunity is that with this financial cushion, they can invest in their core businesses and perhaps launch new products or expand into new markets. Overall, it appears to be a sound financial adjustment, but the real test will be in the company's execution and future performance. Alright, that is our quick decode of this Bausch Health filing. What's your take on this debt exchange? Do you think it's a smart move or a sign of trouble ahead? Let us know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more corporate insights. Don't forget to join our Discord community linked in the description for more discussions. Thanks for watching and we'll see you in the next video.